What if the biggest danger in investing was not a crash, not a recession, not even a bad company, but something far more invisible, far more patient, far more deceptive, something that simply kept prices flat for years and years, while inflation quietly ate your purchasing power from the inside out? That is exactly the world Vitaliy Katsenelson is talking about, and that is exactly the world many investors are living in right now without even realizing it. This is not a story about doom. It is not a warning to sell everything and hide. And it is certainly not a prediction about the end of capitalism. This is something far more useful, far more actionable, and far more grounded in history than most things you will hear in financial media today. This is a guide, a clear, honest, and deeply researched guide for how to not just survive a sideways market, but actually thrive inside one. And by the time you reach the end of this, you will look at investing in a completely different way. You will stop chasing index funds blindly. You will stop trusting price movements alone. You will start thinking like an owner of businesses rather than a collector of tickers. And you will begin to see that the real edge in a sideways market belongs not to the fastest, not to the most aggressive, but to the most thoughtful. So let us begin at the very beginning with the question that changes everything. What exactly is a sideways market, and why does it matter more than almost anything else in your financial life right now? The market goes up, the market goes down. Everyone knows that. But what most people never learn, what the financial industry rarely talks about clearly, is that sometimes the market does something far stranger and far more damaging. Sometimes it simply goes sideways, moving up and down in endless cycles without ever truly advancing, leaving investors exactly where they started, except older and poorer in real terms and more confused than ever. Katsenelson calls these periods sideways markets, also known as range-bound markets, and he is not describing a short correction or a brief pause in a bull run. He is describing entire decades. He is describing long, grinding stretches of time where the major market indexes produce little to no real return, where every rally is followed by a retreat, where optimism and pessimism take turns in an exhausting cycle, and where the average investor who simply holds an index fund and waits gets almost nothing for his patience. The 1960s and 1970s were a sideways market. The 1930s and 1940s were a sideways market. And according to Katsenelson's careful analysis, the early 2000s marked the beginning of yet another sideways market that may still be playing out in different forms even today. These are not rare historical curiosities. They are recurring features of the market, and they happen for reasons that are logical, predictable, and understandable once someone takes the time to explain them properly. The engine behind every bull market and every sideways market is the relationship between three things: earnings, dividends, and valuations. And Katsenelson breaks this relationship down in a way that is elegant in its simplicity. In a true bull market, all three of these forces tend to work together in your favor. Companies are earning more money, they are paying out more in dividends, and investors are willing to pay higher and higher prices for every dollar of those earnings, which means valuations expand, and that expansion multiplies your gains on top of the gains from earnings and dividends already. So everything compounds beautifully and powerfully. But in a sideways market, something shifts. Usually what happens is that valuations enter the picture as a headwind rather than a tailwind. Companies may still be earning money, dividends may still be paid, but the price the market is willing to pay for those earnings contracts rather than expands, which means even a healthy company generating real profits can produce a stock that goes nowhere for years because the multiple investors are willing to assign to those earnings is shrinking. This is the trap, and it is a trap most investors never see coming because they spend so much time watching prices and so little time understanding what drives prices over the long run. Katsenelson wants you to understand this mechanism deeply, not just conceptually, but intuitively, so that when you encounter it in real time, you are not confused, you are not panicked, you are not tempted to make destructive decisions. Instead, you are prepared, you are patient, and you are positioned correctly. Now let us go a little deeper into history, because history is the best teacher we have when it comes to markets, and Katsenelson is a very serious student of it. Look at the period from 1966 to 1982. Those 16 years represent one of the most dramatic examples of a sideways market in modern history. The Dow Jones Industrial Average started 1966 at around 1,000 points, and it ended 1982, still hovering right around that same level, 16 years, and the index had gone essentially nowhere in nominal terms, but in real terms. Adjusted for the inflation that was devastating purchasing power throughout the 1970s, investors had lost an enormous portion of their wealth simply by holding on and trusting that the market always goes up eventually. The emotional experience of living through that period must have been exhausting. There were rallies that felt like the beginning of a new era, followed by crashes that wiped out those gains, followed by recoveries that gave hope, followed by declines that crushed it again. And this cycle repeated again and again for 16 years, while inflation worked silently in the background like a pickpocket at a busy market. And yet, within that same terrible period for passive index investors, there were individual companies that performed spectacularly. There were industries that thrived. There were active investors who understood what they owned and why they owned it, who made extraordinary returns while the index sat still. This is the central lesson that everything else in this material builds on. In a sideways market, the overall index may deliver nothing, but active stock selection based on value and quality can deliver meaningful returns. The key is knowing how to select, knowing what to look for, and knowing when the price being offered by the market represents genuine opportunity. Before we go further into how to find those opportunities, it is worth spending a moment understanding why sideways markets end, because understanding the exit is just as important as understanding the entrance. Sideways markets typically end in one of two ways. Either the market corrects sharply and dramatically, which brings valuations down to levels where they can once again expand meaningfully, or time simply passes and earnings grow into the high valuations that existed at the start of the sideways period, effectively catching up to what prices already reflected. In most historical cases, it has been a combination of both, and in both cases, what eventually follows is a new bull market, which is why sideways markets, as painful as they are not permanent. They are not signs that capitalism is broken. They are not harbingers of permanent decline. They are transitional periods, expensive ones certainly, but transitional nonetheless. Knowing this helps you hold your conviction when the going gets long and frustrating. Knowing this helps you stay in the game when others are giving up. Knowing this helps you keep making rational decisions when the emotional pressure to do something reckless is at its highest. Now let us talk about the tools Katsenelson gives you for navigating this environment. And the first and most important tool is a genuine shift in mindset from thinking about stocks as prices to thinking about stocks as ownership stakes in real businesses. This sounds simple, and in fact, almost every serious investor you will ever study has said something like this at some point. But the difference between knowing this intellectually and actually living it in your investment behavior is enormous. And Katsenelson is very interested in helping you close that gap. When you think of a stock as a price, you are essentially gambling on what someone else will be willing to pay for it in the future. You are in the business of predicting mood, predicting sentiment, predicting crowd behavior, which is an extraordinarily difficult game to win consistently. And in a sideways market, where mood swings wildly and unpredictably, it is almost impossible. But when you think of a stock as an ownership stake in a real business, your entire frame of reference changes. Now you are asking different questions. You are asking whether this business generates real cash, whether it has a durable competitive advantage, whether the management team is honest and capable, whether the price you are being asked to pay represents fair value or better for the earning power of this enterprise. These are questions that have answers. They require research and judgment, but they are fundamentally answerable. And when you anchor your investment decisions to these answers rather than to price movements, you are playing an entirely different and far more winnable game, especially in a sideways market where the index goes nowhere. But individual businesses with real value continue to compound their worth over time. Katsenelson is deeply influenced by the tradition of value investing that runs through Benjamin Graham and Warren Buffett and Charlie Munger, but he is not simply repeating their ideas, he is updating them, contextualizing them, and most importantly, applying them specifically to the sideways market environment that he believes defines the world investors are operating in. One of the most important concepts he develops is the idea of thinking about your portfolio not as a collection of stocks, but as a collection of companies you have chosen to own partial stakes in. And this distinction matters because it changes what you look for. It changes your time horizon. It changes your reaction to price drops. And it changes the standards you apply when deciding what to buy and what to avoid. When you own a company, a drop in its stock price is not automatically a disaster. In fact, it can be an opportunity to buy more of something you already believe in at a lower price. This is one of the counterintuitive joys of the sideways market environment. It frequently offers you exactly these opportunities. It brings prices down to levels where genuine value is on sale. And if you are prepared, if you have done your research, if you understand what you own and why, those moments of market fear become your moments of maximum advantage. But you can only take advantage of those moments if you have prepared in advance, if you have identified the companies you want to own, if you understand their businesses deeply enough to distinguish a temporary setback from a permanent impairment, and if you have the emotional discipline to act when everyone around you is selling in panic. This preparation is what Katsenelson calls building a shopping list, and it is one of the most practical pieces of advice in this entire framework. Before the market falls, before the panic sets in, before prices drop to attractive levels, you need to know exactly what you would want to buy if prices came down to certain levels. You need to have done the work, made the assessments, formed the convictions, so that when opportunity knocks, you are not scrambling to figure out what to do. You are simply executing a plan you have already made. This is the discipline of a serious long-term investor, and it separates those who consistently do well in sideways markets from those who get whipsawed by their own reactions to price movements. Now let us talk about what kinds of companies Katsenelson believes are best suited to a sideways market environment, because not all businesses perform equally well in this kind of prolonged, low-return landscape, and understanding the characteristics of sideways market winners is essential knowledge for any investor who wants to do better than the index. The first characteristic is quality of earnings, and this is a concept worth spending real time on because it is more nuanced than it might initially appear. Not all earnings are created equal. A company can report high profits while generating very little actual cash. A company can show strong earnings per share growth while diluting shareholders through excessive stock-based compensation. A company can appear profitable while actually consuming more capital than it generates. And in each of these cases, the reported earnings number is misleading in a potentially dangerous way. Katsenelson wants you to look beyond the headline earnings number to the underlying cash generation of the business. Cash is real in a way that accounting earnings sometimes are not. Cash cannot be manipulated as easily as net income. Cash is what pays dividends. Cash is what funds growth. Cash is what gives a business resilience when the economy turns difficult. And in a sideways market where overall returns are compressed, Investing in companies with genuinely high-quality earnings and strong cash generation gives you a real advantage over time. The second characteristic he emphasizes is the durability of competitive advantage, which is a concept you may have heard described in various ways, moat being the most common term. A company with a durable competitive advantage can maintain its profitability over long periods of time without constantly having to reinvest at extraordinary rates just to stay in place. This is enormously important in a sideways market because you need your companies to keep compounding their intrinsic value even when the market is not rewarding that compounding with higher prices. And eventually, when the market does start to recognize value again, those companies with durable advantages will have built up far more intrinsic worth than companies in highly competitive industries that struggle just to maintain their position. Think about what makes a competitive advantage durable: brand recognition that commands pricing power and customer loyalty, switching costs that make it painful for customers to move to a competitor, network effects that make the product more valuable as more people use it, cost advantages that come from scale or proprietary processes or access to unique resources, and regulatory or intellectual property protections that create legal barriers to competition. A company possessing one or more of these characteristics in a genuine and sustainable way is the kind of company you want to own in a sideways market, because even when the stock price is going nowhere for a year or two, the underlying business is quietly building more value, and that value will eventually be recognized. The third characteristic Katsenelson highlights is management quality and alignment, which is perhaps the most difficult to assess, but also one of the most consequential factors in long-term investment outcomes. Good management does not just mean smart people, although intelligence matters. Good management in the context of an investment means people who think like owners rather than employees, people who allocate capital thoughtfully rather than pursuing growth for its own sake, people who are honest with shareholders about the challenges the business faces rather than spinning everything into optimistic language, people who take sensible risks rather than gambling with shareholder money to hit short-term targets. In a sideways market, management quality becomes even more critical because there is less overall tailwind from rising valuations to cover up poor capital allocation decisions. Every dollar management spends on an acquisition, every share repurchase decision, every new product investment, every pricing decision matters more when the environment is not forgiving excess, and great managers navigate these decisions with a discipline and thoughtfulness that compounds over time, while mediocre managers burn capital on initiatives that look good in press releases but destroy shareholder value over the long run. How do you assess management quality? Katsenelson suggests. Looking at their track record of capital allocation over multiple years, looking at how they behave during difficult periods rather than just good ones, looking at whether their compensation is genuinely aligned with shareholder outcomes rather than metrics they can easily game, and perhaps most importantly, listening carefully to how they talk about their business, whether they are honest about risks and uncertainties, or whether they project unrealistic confidence, whether they take responsibility for mistakes or always have an excuse, whether they have a clear and coherent strategy or simply react to whatever the environment demands. Great managers have a long-term vision. They communicate it clearly, they execute against it consistently, and they are honest when results fall short. These are the people you want running the businesses you own, and finding them is one of the great competitive advantages available to a thoughtful stock picker in a sideways market. Now, beyond the characteristics of the individual companies, Katsenelson also has a great deal to say about valuation, about the price you pay for even a great business. And this is where some of the most practical and immediately actionable advice in this framework lives. The cornerstone of his approach to valuation is the price-to-earnings ratio, which is the relationship between what a stock costs and how much profit the underlying company generates per share. And while this is one of the most well-known metrics in all of investing, Katsenelson's treatment of it goes considerably deeper than most. He starts from a very important baseline observation. When you buy a stock at a high valuation, you are essentially borrowing returns from the future. You are paying today for earnings that have not yet been generated. And if anything disappoints along the way, whether earnings come in lower than expected or the broader market's appetite for high multiple stocks decreases, you face a double hit to your returns, earnings going the wrong direction and the multiple contracting simultaneously. In a sideways market, this dynamic is particularly brutal because you cannot rely on a rising tide of expanding multiples to bail you out if you overpay. The market's overall appetite for high valuations is already contracting in a sideways environment, which means any individual stock you buy at a stretched valuation is fighting two headwinds at once. This is why Katsenelson is emphatic about the importance of buying at a reasonable price, not just buying a great business, but buying a great business at a reasonable price. And he provides a framework for thinking about what reasonable looks like in different contexts. The starting point is what he calls the fair value price-to-earnings ratio, which is an estimate of the multiple the market should assign to a company's earnings given its growth prospects, its financial stability, and its dividend yield. This is not a precise formula, but a structured way of thinking through what you are paying for and whether that price is justified by what you are getting. He suggests that a company with modest growth prospects, stable but not exceptional earnings, and a moderate dividend should trade at a price-to-earnings ratio around 15, which has historically been close to the market's long-run average, and he then adjusts up or down from that baseline based on the specific characteristics of the company in question. A company with exceptional and reliable earnings growth gets a higher fair value multiple. A company with volatile or declining earnings gets a lower one. A company with a strong dividend yield that effectively returns capital to shareholders gets some credit for that in the valuation. A company with significant debt or cyclical business risk gets a discount. The result of this structured thinking is not a single magic number, but a range of what seems like reasonable value, and the investment decision becomes whether the current market price represents a discount to that range of fair value, a premium, or something roughly in line. Buying when the market offers you a meaningful discount to your estimate of fair value is the core discipline of value investing, and it is particularly powerful in a sideways market because those discounts appear more frequently as the overall market goes through its cycles of pessimism and optimism without ever trending strongly in one direction. When the market falls during one of its pessimistic cycles, it often drags down good companies along with bad ones, creating opportunities for investors who have done their homework to buy quality at prices that the business's fundamental earning power clearly justifies, and then hold it until the market's mood improves and prices reflect that quality more accurately. This patient cycle of buying quality at a discount and holding until fair value is reached, then either holding further if the business continues to compound or rotating into something else the market has temporarily mispriced, is the rhythm of successful investing in a sideways market, and Katsenelson describes it with a clarity and practicality that most investment frameworks lack. Let us now talk about the importance of dividends in a sideways market, because this is one of the areas where Katsenelson's advice diverges most sharply from the conventional wisdom that dominates most investment conversation in the media and in popular financial books. In a bull market, dividends are often treated as an afterthought, something retirees care about, something boring, something you give up growth potential to receive. In a world where stock prices are rising by double digits annually, who cares about a 2 or 3-point dividend yield? But in a sideways market, where the index is delivering little or no price appreciation over extended periods, dividends suddenly matter enormously. They become the primary source of total return rather than a minor supplement to capital gains. They provide a steady flow of real cash, even when prices are going nowhere. They give you something to reinvest at attractive prices when the market declines. And they create a discipline in company management because paying a dividend requires actually generating the cash to support it, which tends to focus executives on genuine profitability rather than accounting creativity. Katsenelson makes the case that in a sideways market environment, a company's dividend policy is one of the most important signals of management quality and financial health. A company that pays a growing dividend over time is demonstrating that it generates more cash than it needs for operations and growth, that management is willing to share that surplus with shareholders rather than hoarding it or wasting it on empire building, and that the business model is durable enough to support consistent cash distribution even through economic cycles. He is particularly enthusiastic about companies that have a track record of consistently raising their dividends over time. These dividend growers represent some of the most reliable and attractive long-term investments available in a sideways market because they combine the income advantage of dividends with the compounding advantage of growing income streams. And they tend to be exactly the kinds of high-quality durable businesses that perform well when the overall market environment is difficult. If you reinvest those dividends back into the same stock when prices are depressed, you are buying more shares at lower prices, which accelerates the compounding effect further. And over a 10 or 15-year sideways market, this reinvestment compounding can turn a flat index return into a genuinely meaningful personal portfolio return, which is exactly the kind of outcome Katsenelson is trying to help you achieve. One of the other important themes in Katsenelson's framework is the concept of risk, and specifically, the way most investors think about risk incorrectly, which leads them to make systematically poor decisions, especially in sideways market environments. The conventional understanding of risk in investing is essentially synonymous with volatility. If a stock price moves up and down a lot, it is considered risky. If it moves very little, it is considered safe. And this framework is built into almost every piece of financial regulation, portfolio theory, and investment advice that the mainstream financial industry produces. But Katsenelson, following in the tradition of Graham and Buffett, argues that this is a fundamentally flawed way to think about risk. Volatility is not the same thing as risk. In fact, volatility is sometimes the opposite of risk, because high volatility creates the price dislocations that allow value investors to buy quality companies at discounts to their intrinsic worth, which is actually an opportunity, not a danger, for a prepared investor. The real risk in investing, Katsenelson argues, is the permanent loss of capital, and the factors that drive permanent loss of capital are very different from the factors that drive short-term price volatility. Permanent loss happens when you own a business that is fundamentally broken and cannot recover, when you overpay so dramatically that even a perfectly functioning business cannot generate enough return to compensate over time, when you are forced to sell at the worst possible moment because of leverage or liquidity constraints, or when you simply make decisions based on emotion and short-term thinking that destroy value through poor timing. This reframing of risk has enormous practical implications for how you build and manage a portfolio. If you define risk as volatility, your instinct is to sell when prices fall sharply, because falling prices mean increasing volatility, which means increasing risk in the conventional framework. But if you define risk as the probability of permanent capital loss, your instinct when prices fall should be to evaluate whether the underlying business is still sound, and if it is, to consider buying more rather than selling. This is a profound psychological shift, and it is one that most investors find extremely difficult to execute because our instincts evolved to avoid things that are moving in threatening directions, which means that watching a stock price fall triggers exactly the same fear response that a saber-toothed tiger would have triggered for our ancestors. The rational knowledge that this is a buying opportunity does almost nothing to dampen that instinctive response. This is why Katsenelson places so much emphasis on preparation and on having a clear investment thesis before you buy anything. When you have done your research, when you understand why a business is worth a certain amount, independent of what the market currently prices it at, when you have clearly articulated to yourself what would change your view and what would not, you have something concrete to hold on to when price movements try to hijack your emotions. Your thesis becomes your anchor. It keeps you rational when the market is being irrational. It keeps you focused on what actually matters when everyone around you is focused on things that do not. And in a sideways market, where prices swing up and down without trend, that anchor is worth more than almost any other tool you have. Let us shift now to talking about diversification, which is another concept that Katsenelson treats with far more nuance than you typically encounter in mainstream financial advice. The standard advice on diversification goes something like this: own enough different assets across enough different categories that no single loss can significantly damage your portfolio. And the ultimate expression of this advice is the broad index fund, which owns hundreds or thousands of stocks and therefore cannot be hurt badly by any single company's failure. Katsenelson does not dismiss diversification. He acknowledges that it is genuinely useful protection against the risk of being catastrophically wrong about a single company. But he pushes back hard against the idea that more diversification is always better, and specifically against the idea that owning the entire market through an index fund is the optimal strategy in a sideways market environment. The problem with extreme diversification in a sideways market is that it guarantees you the market's mediocre average return, and in a sideways market, that average return is essentially nothing after inflation. You are working hard to stay in place. You are accepting the illusion of safety in exchange for the certainty of going nowhere. Katsenelson's preferred approach is what he calls focused diversification, owning a relatively concentrated portfolio of perhaps 20 to 30 carefully selected high-quality companies across different industries and geographies. Enough diversification that a single failure will not destroy you, but concentrated enough that your research into each position actually matters, that you know your companies deeply, that you are not simply indexing the market through a longer route. He is careful to note that this approach requires genuine commitment to research and analysis. It is not for investors who are not willing to do the work, because the whole point of a more concentrated portfolio is that each holding is there for a specific reason, rooted in specific knowledge. And if you do not have that knowledge, the concentration becomes recklessness rather than informed confidence. But for investors who are willing to do the work, who find the process of analyzing businesses genuinely interesting and even enjoyable, the focused portfolio approach offers real advantages in a sideways market. It allows you to own your best ideas at meaningful weights rather than diluting them to insignificance. It gives you the ability to act decisively when unusual opportunities appear, and it creates a portfolio that you understand deeply rather than a collection of hundreds of companies you know almost nothing about individually. One of the most fascinating sections of Katsenelson's thinking deals with the question of international investing and geographic diversification, and this is an area where his perspective is particularly valuable for investors who have been primarily or exclusively focused on their home market. Different countries and regions enter and exit sideways markets at different times, and this means that the opportunity set available to an investor willing to look globally is always larger than the opportunity set available to someone who restricts themselves to a single market, even a large and sophisticated one like the United States. When valuations in one country or region are stretched and suggesting a period of below-average returns ahead, there are almost always other parts of the world where valuations are more attractive, where economic conditions are more favorable, where the relationship between price and underlying business value is more compelling. Katsenelson encourages investors to think of the global market as their universe, rather than their home market alone. Not because international investing is without additional risks. It certainly carries currency risks and political risks and accounting standard differences that require attention, but because restricting yourself unnecessarily to a single market when better opportunities exist elsewhere is simply leaving potential returns on the table. He is particularly interested in emerging markets and other less followed areas of the global investment landscape, not because they are automatically better than developed markets, but because less investor attention means more opportunities for prices to diverge meaningfully from underlying value, which is exactly the kind of inefficiency that a value investor can exploit. The key to international investing in his framework is not to make macro bets on countries or currencies, but to apply the same company-by-company analysis he advocates everywhere, finding specific businesses in specific countries that meet the standards of quality, durability, and reasonable valuation he has described, regardless of where their headquarters happen to be located. Now let us talk about one of the most psychologically challenging aspects of investing in a sideways market, which is the question of patience and what Katsenelson calls the virtue of doing less. In a culture that rewards busyness, that celebrates constant action and activity, that treats doing nothing as laziness or lack of effort, the investment insight that doing less is often better is genuinely counterintuitive and genuinely difficult to accept. But in a sideways market, where opportunities are concentrated and appear irregularly rather than constantly, where the temptation to trade frequently is always present and almost always destructive to long-term returns, the ability to sit patiently and wait for genuinely attractive opportunities is one of the most valuable skills an investor can develop. Katsenelson describes this patience in terms of what he calls the high-quality idle time of an investor, the hours and days and weeks when the market is not offering anything compelling, when your existing holdings are performing reasonably but not presenting new opportunities, when the right thing to do is simply nothing, and the discipline to recognize this and act accordingly, which means not acting, is harder than it sounds and more valuable than most investors realize. The alternative to this patience is what behavioral finance researchers call the disposition effect, the tendency to sell winners too early and hold losers too long, and action bias, the tendency to do something, anything, rather than wait. Both of these tendencies cost investors enormous amounts of return over time, and they are both more dangerous in a sideways market than in a bull market because there is no overall upward trend to compensate for trading errors. The antidote Katsenelson offers is a clear decision-making process that keeps you anchored to fundamentals rather than to price movements or to the desire for activity before taking any action in your portfolio. Whether buying or selling, you should be able to articulate clearly why this action makes sense based on the business fundamentals and the price being offered, not based on recent price performance, not based on what a commentator said on television, not based on a feeling that something is about to happen. If you cannot articulate the fundamental reason, you should not act, and this discipline, simple in description but challenging in practice, will save you from a large proportion of the mistakes that sideways markets seduce investors into making. There is another dimension to Katsenelson's thinking about patience that is worth examining closely, which is his perspective on the role of cash in a portfolio. Conventional portfolio theory treats cash as a drag on returns, a dead weight that earns nothing, while your stocks are theoretically compounding, and in a strong bull market this is more or less true. Holding large amounts of cash, while the index is rising at 15 points per year, is genuinely costly. But in a sideways market, cash serves an entirely different function. It is not dead weight. It is dry powder. It is the ammunition you need to take advantage of the buying opportunities that appear when market pessimism creates temporary price dislocations in high-quality businesses. Katsenelson is comfortable holding meaningful amounts of cash when the market is not offering attractive opportunities, and he regards the ability to act decisively with available capital when genuine opportunities appear as one of the most important advantages a disciplined investor can have over the typical market participant who is always fully invested and must sell something to buy something else. This optionality has real value, particularly in a sideways market where the cycles of pessimism and optimism create regular windows of attractive pricing, and investors who have kept some powder dry can exploit those windows, while investors who are always fully invested in lower quality opportunities at higher prices cannot. The discipline here is in the selling as much as in the holding. Knowing when to sell a position that has reached or exceeded its fair value to create the cash that can be redeployed at better prices later is an important part of the active management approach Katsenelson advocates, and it is quite different from the mentality of either holding everything forever or trading in and out of positions reactively based on price movements. When a position reaches what you estimate to be its fair value, the return prospect from that point forward is essentially just the normal return on a fairly priced asset, which may be acceptable, but is not the superior return you were looking for when you bought it at a discount. So the thoughtful thing to do is to begin selling gradually, capturing the gain, returning to cash, and waiting for the next opportunity where the market's mood creates another discount worth exploiting. This cycling between opportunistic buying and disciplined selling, always anchored to your estimates of business value rather than to price trends or to external predictions, is the practical rhythm of what Katsenelson is teaching, and it is a rhythm that can generate genuinely attractive returns even in a market environment that delivers nothing to passive investors. Let us now address one of the most important and often most emotionally charged aspects of investment decision-making, which is the question of when to sell, and specifically, when to sell a position that has declined in value since you bought it. This is the question that causes the most psychological pain for most investors, and it is the question where the most money is destroyed through poor decision-making, because the combination of ego and loss aversion creates a powerful tendency to hold declining positions long past the point where rational analysis would suggest selling, simply to avoid the psychological pain of locking in a loss. Katsenelson's framework for making sell decisions is centered around the concept of the original investment thesis. When you bought the stock, you had a reason, a specific argument for why this business was worth more than the market was pricing it at. And the key question, when a stock declines, is whether that original thesis is still intact. If the stock has declined because of factors that are temporary and do not affect the fundamental value of the business, the right response is to hold and perhaps to buy more. If the discount to your estimate of value has widened, this is the situation where adding to a declining position can be very attractive. But if the stock has declined because the original thesis was wrong, because the competitive advantage you thought existed does not actually exist, because the earnings quality you believed in was illusory, because the management you trusted has made decisions that reveal poor judgment or misaligned incentives, or because the industry dynamics have changed in ways that permanently impair the business, then holding on is not patience, it is denial. And selling the position and taking the loss, however painful, is the rational and correct thing to do. The discipline of distinguishing between these two situations, between temporary setbacks to a still valid thesis and genuine impairment of the underlying business, is one of the most demanding skills in investing. It requires intellectual honesty about your own previous judgments. It requires a willingness to update your views based on new information, rather than defending the analysis that led you to buy in the first place. And it requires the emotional courage to realize a loss, rather than let it grow in the hope that things will eventually work out. Katsenelson also addresses the situation where neither of these extremes applies, where the thesis is partially intact, where the business is neither clearly fine nor clearly impaired, and in these ambiguous situations, he generally advocates reducing rather than eliminating the position, acknowledging the uncertainty by lowering your exposure while maintaining some stake in the outcome if things ultimately resolve favorably. This graduated approach to position management reflects a more nuanced and honest engagement with investment reality than the binary buy or sell mindset that most investors default to. It acknowledges that uncertainty is the normal condition of investing rather than something to be eliminated, and it allows you to act appropriately even when you do not have complete information. Now, Katsenelson also spends considerable time on the subject of the broader economic and market environment and how to think about it without falling into the trap of macro prediction, which is one of the most seductive and most consistently unsuccessful activities in all of finance. Macro prediction, which means trying to forecast the overall direction of the economy, interest rates, currency movements, inflation, and other large-scale forces, is something that almost every market commentator and financial media personality engages in constantly, and it is something that has an extremely poor track record among even the most sophisticated and well-resourced practitioners. Katsenelson's position is not that macro factors are irrelevant. They clearly affect individual businesses and overall market valuations in important ways, but that trying to make investment decisions primarily based on macro predictions is a fundamentally unreliable approach that introduces enormous uncertainty and frequently leads to either paralysis or action at exactly the wrong moment. His preferred approach is to be aware of macro conditions and to factor them into your analysis of individual businesses, understanding how a rise in interest rates might affect a company with significant debt, how inflation might affect a business with pricing power versus one without, how a slowdown in a particular economy might affect companies with heavy exposure to that market, but to make your ultimate investment decisions based on business-by-business analysis of quality, durability, and valuation, rather than on bets about which way the macro winds will blow. This is a practical and humble approach that recognizes the limits of what any investor can reliably know and predict, and it is entirely consistent with the business owner mentality that underlies everything else in his framework, because a business owner focuses on what they can control and analyze, rather than on macro forces that are beyond anyone's reliable prediction. There is also an important section of Katsenelson's thinking dedicated to the behavioral and emotional dimensions of investing, which is increasingly recognized as one of the most important determinants of investment outcomes, even for investors who have all the analytical tools they need. Understanding human psychology, and specifically understanding your own psychological tendencies, is essential to navigating a sideways market successfully, because the sideways market is specifically designed, as if by some perverse architect, to trigger every cognitive bias and emotional error that investors are prone to. The long periods of flat returns create frustration and the temptation to abandon a disciplined approach for something more exciting. The sharp rallies create overconfidence and the temptation to chase momentum. The sharp declines create fear and the temptation to sell everything and wait for clearer skies, and the general sense of going nowhere creates a background anxiety that makes every decision feel more urgent and more consequential than it actually is. Katsenelson catalogs many of the most common behavioral errors that trip up investors in this environment, starting with anchoring, which is the tendency to fixate on a particular price level, usually the price you originally paid for a stock, and to evaluate the stock's attractiveness relative to that anchor rather than relative to its actual current value and future prospects. This leads to the classic mistake of holding a position that has declined simply because you paid a higher price for it and you are waiting to get back to even, as if the stock knows or cares what you paid for it. The market does not owe you a return to your purchase price. The business's value is what it is regardless of your cost basis, and the relevant question is always whether the current price represents an attractive return from here forward, not whether it is above or below where you personally entered. Another critical bias is confirmation bias, the tendency to seek out and give extra weight to information that confirms your existing views while dismissing or underweighting information that challenges them. This is particularly dangerous in investment because it means you effectively stop gathering the objective information you need to make sound decisions the moment you have made an investment, replaced by a filter that shows you only the reassuring information. The antidote Katsenelson offers is what he calls the red team approach, actively seeking out the best arguments against your own investment thesis, finding the smartest critics of the businesses you own, and taking their arguments seriously, forcing yourself to steelman the case against your position before you dismiss it. This intellectual discipline is uncomfortable but genuinely useful, and it is a significant competitive advantage over investors who only seek out confirming information. Overconfidence is another pervasive problem, the tendency to believe that your analysis is more accurate and your predictions more reliable than they actually are. This is one of the most consistent findings in behavioral finance research. Virtually everyone, including professional investors, overestimates the accuracy of their own forecasts, and in a sideways market where many of the usual tailwinds are absent, this overconfidence can lead to positions that are too concentrated in a single view or too slow to adjust when evidence contradicts expectations. Katsenelson's response to overconfidence is to build humility into the process, to always hold your investment theses with appropriate uncertainty, to size positions in proportion to both the opportunity and the conviction you can honestly claim, and to remain genuinely open to evidence that your original analysis was wrong, rather than defending it reflexively. The final major behavioral theme he addresses is what behavioral economists call loss aversion, the well-documented tendency to feel the pain of losses more intensely than the pleasure of equivalent gains, which causes investors to make systematically poor decisions around both holding declining positions and selling profitable ones. Loss aversion manifests in investment as the reluctance to sell a position that has declined because doing so locks in the loss psychologically, even when rational analysis clearly indicates that selling is the right financial decision. And it also manifests as the eagerness to sell positions that have risen and lock in the gain before the market can take it back, even when rational analysis suggests holding further. Both of these tendencies are counterproductive. They lead to portfolios that are systematically tilted toward losers and away from winners, the opposite of what good investing requires. And the only reliable antidote is to make all buy and sell decisions based on explicit analysis of business value and price, rather than on the psychological need to avoid feeling like you have lost something. This requires developing a relationship with loss that is healthier and more rational than most people's default, recognizing that losses on individual positions are not personal failures, but simply information about where your analysis was incomplete, and using that information to improve your process rather than to punish yourself emotionally. The most successful investors are not those who never make mistakes. Every investor makes mistakes, even the greats. The most successful investors are those who learn from their mistakes efficiently, who take the information in a loss quickly and without excessive emotional weight, and who apply that learning systematically to improve their future decisions. Now, let us bring together everything we have discussed and paint a complete picture of what it looks like in practice to invest successfully in a sideways market using Katsenelson's framework. The starting point is mindset. You must genuinely and deeply internalize the idea that you are an owner of businesses rather than a trader of prices. This is not just a slogan, it is a complete reorientation of how you think about every aspect of the investing process, from what information you seek out, to how you react to price movements, to how you measure success over time. From that mindset flows the research process, which involves identifying businesses with the characteristics that make them valuable long-term holdings: high quality and growing earnings, durable competitive advantages, honest and capable management aligned with shareholders, and a record of treating shareholders well through sensible capital allocation and appropriate dividends. These are not always easy businesses to find, and the list of candidates is always shorter than investors hope. But the discipline of applying these criteria rigorously filters out the large number of mediocre or problematic businesses that populate every market and leaves you with a much higher quality universe to choose from. From the research process flows the valuation discipline. Understanding what a fair price for each of your candidate businesses would be based on their earnings power, growth prospects, financial stability, and dividend policy, and being willing to wait until the market offers you these businesses at prices that represent a meaningful discount to that fair value. This waiting is not passive. It is active preparation for action when opportunity appears. It involves maintaining your shopping list, tracking your candidates continuously, understanding their businesses deeply enough to react quickly when prices reach attractive levels, and having the cash available to act when those moments come. From the valuation discipline flows the portfolio management approach, which involves building a focused collection of your best opportunities, sized appropriately to your conviction and the available discount to fair value, and managed dynamically as prices change and business conditions evolve. When a holding reaches or exceeds fair value, you trim or sell, creating cash for the next opportunity. When the market creates temporary panic and prices of your best holdings fall to attractive discounts, you add to them, always anchoring your decisions to your analysis of business value rather than to price trends or macro predictions or the noise of financial media. And underlying all of this is the behavioral discipline that Katsenelson emphasizes throughout: the ability to think clearly when the market is creating emotional pressure, the ability to distinguish between what matters and what does not, the ability to hold your convictions with appropriate confidence while remaining genuinely open to evidence that they need updating, and the patience to sit through long periods of apparent inaction when the market is not offering compelling opportunities. This is not a simple system. It requires genuine intellectual engagement and ongoing effort. It requires a certain personality type that finds analytical work intrinsically interesting rather than tedious, and it requires emotional resilience that does not come naturally to everyone. But for investors who bring these qualities to the process, Katsenelson's framework offers something rare and genuinely valuable: a coherent and historically grounded approach to generating attractive returns in a market environment that delivers nothing to passive investors, a way to thrive where most investors merely survive or worse. And the beauty of this approach is that it does not require you to predict the future. It does not require you to be smarter than everyone else about macro conditions or market direction. It does not require you to take reckless risks or to make dramatic all-in bets. It requires you to be thoughtful, patient, honest, and disciplined, qualities that are genuinely available to any investor willing to develop them. Before we conclude, let us spend a moment on the broader context of why all of this matters now. Why the sideways market framework is not just historically interesting, but urgently relevant for investors in today's environment. The period that began in the late 1990s and early 2000s has seen enormous volatility, periods of extraordinary gains, periods of devastating losses, and a monetary environment of near-zero interest rates that created conditions quite unlike anything in most investors' experience. It has also produced valuations at various points that by historical standards suggested significant risk of below-average returns going forward, exactly the kind of environment where Katsenelson's framework is most valuable. The specific features of today's market will inevitably differ from the historical examples he discusses. Every period has its unique characteristics, but the underlying dynamics of valuation, earnings growth, and investor psychology operate in the same fundamental ways they always have, because they are driven by human nature and basic economics rather than by technologies or policies that change with each generation. The investors who will navigate the coming years most successfully are almost certainly those who understand these fundamental dynamics deeply, who have the analytical tools to identify genuine value when the market creates it, who have the behavioral discipline to act on that analysis calmly and rationally, and who have the patience to let the compounding of quality businesses work over the long periods that the sideways market environment requires. Katsenelson's framework gives you all of these things, not as theoretical abstractions, but as practical, actionable disciplines grounded in real investment experience and rigorous historical analysis. And the investors who genuinely internalize and apply this framework will have a significant and durable advantage over those who do not. The sideways market is not going anywhere anytime soon. It may persist for years, or even for another decade or more in various forms. And the investors who thrive in this environment are those who stop fighting it, stop expecting it to behave like the bull markets of the past, and start using the specific tools and disciplines that this specific environment rewards. That is the promise of the approach described here. Not easy riches, not a guaranteed path to wealth, but a clear and honest framework for generating meaningful returns through your own intellectual effort and emotional discipline in a market environment that will otherwise leave you standing still while inflation quietly erodes everything you have worked to save. And that promise, clear, honest, grounded, and genuinely achievable, is worth every bit of attention and effort you can give to understanding and applying it in your own investment life. The sideways market will test you. It will frustrate you. It will at times make you question whether all this analysis and discipline is worth it. But for those who stay the course, who keep applying the framework even when it feels like it is not working, who keep buying quality at discounts and holding with conviction and selling when value is reached, the long-run rewards are real, they are meaningful, and they are there for you if you are prepared to earn them. This is the essential message Katsenelson wants every investor to carry with them, that in the sideways market, the prepared mind, the disciplined process, and the patient temperament are the most valuable assets you can possibly own, more valuable than any hot tip, any exciting new technology, any macro prediction, or any emotional reaction to the daily noise of the market. Own your businesses, understand their value, pay fair prices, be patient, stay disciplined, and let the compounding work. That is the path through the sideways market, and it is one that has always been available to those who are willing to follow it.